This is Paul Donovan from UBS's Global Economics Department. In recent days, those most sensitive of creatures, the equity traders, have been emerging from their hideouts and cautiously sniffing the wind of change, much like gophers poking their heads out of their underground bunkers. Unfortunately, it is not the delicate scent of optimism that is carried on the breeze. It is the acrid smell of a huge conflagration as the economic outlook is consumed in a fireball of pessimism and deleverage. Anyone foolish enough to emerge too far into the real world risks being burned to a crisp. The best strategy is probably to remain curled up under one's desk in the fetal position for the next 2 years. UBS has today revised its global economic outlook. We are now projecting the worst economic climate since the Reagan recessions of 1981 and 1982. The economic downturn is deeper and of longer duration than had previously been thought. In 2009, we forecast negative growth for the States, negative growth for the Eurozone, negative growth for the United Kingdom, and negative growth for Canada. The fastest growing G7 economy in 2009 is Japan, because at 0.1% growth, it is the only growing G7 economy in 2009. Global growth is forecast at 1.3% next year from an earlier estimate of 2.2%. Those who look to 2010 for a sign of optimism should retreat now while there is still time. There will be a recovery in 2010. Negative growth is extremely difficult to achieve, even for 1 year. It would take supreme policy incompetence to achieve it 2 years in a row. Nevertheless, 2010 sees but a limited recovery to the distinctly sub-trend growth environment of 2.9% globally. No major economy returns to trend. Why is this happening? First, the financial crisis is worse than had been expected. That gives a more significant negative impulse to growth, as weaker sentiment leads to weaker investment and weaker consumer spending. Second, banks have become more conservative than expected. As a result, the amount of borrower deleverage that is required before normal lending is resumed is greater. That takes longer to achieve, and it entails a more significant downturn. Third, the increased cost of capital slows both investment and employment growth, creating a classic demand-deficient slowdown in the economy. Fourth, emerging markets have been caught up in the climate of general risk aversion and have been, rather than providing a mitigation to growth weakness, they are now directly contributing to it in some cases. Fifth, there have been policy errors already. Arguably, the decision to ban short selling directly contributed to the weakness in emerging markets, spreading the extent of the crisis unnecessarily and adding additional risks. What needs to happen now? First, rate cuts, lots of them, and as soon as possible. Rate cuts mean money is given to existing borrowers, which makes deleverage easier and faster. Ironically, the Bank of Japan's rate cut today, a bitterly divided decision, was the one easing that is not needed, as Japan has already had its deleveraging process. Second, fiscal stimulus. Spending has a bigger impact on the economy normally, though tax cuts will in this instance give money to borrowers and others and speed the process of deleverage. Third, normalization of the banking system. This is underway, but it is taking time. What are the economic consequences? First, disinflation. Lower inflation rates everywhere. We have weaker commodity prices and, far more important, weaker labor cost growth in the face of rising unemployment. Remember that labor costs are overwhelmingly the most important driver of inflation. Second, a stronger dollar, albeit slightly. We're significantly below consensus in our expectations for European growth and policy rates, suggesting a weakening of the euro. For the yen, however, we see little movement. Risk aversion keeps Japanese investors at home, though the independence of the Bank of Japan has been called into question by today's rate cut. Third, the long-term trend rate of growth of the world economy is, in all probability, lower. Higher risk premia are likely to become embedded, and that will reduce long-term growth. Where is the good news? It is not the 1930s. There is no Great Depression. We see risks surrounding these forecasts as being symmetrically balanced. Hitherto, we've only had downside risks. And whoever is unfortunate enough to win the presidential election in the United States next week will be able to run for re-election in 2012 on the slogan, "It's morning again in America." In the meantime, duck and cover. That's all for today. Have a good day.